Hello everyone, my name is Ankit and welcome to Simply Investing. Welcome to part 2 of the video, Top 30 Dividend Stocks. I really want to share all 30 of them and I want to keep this video nice and short. Hence, here's the second part. If you haven't already checked out the first part, I would really recommend that you check this video out because this video is continuation of part 1 that had just released earlier. So let's jump right in. We have our ETFs. I'll be starting with XEI, which is a high dividend yield ETF, 4.82%. I find these ETFs to be a great way to be making the passive income because a lot of them pay you monthly, similar to REITs. So here's XEI. It has some of the highest dividend yield companies in the TSX, and so over the last year you can see it's recovered pretty well, and over the last 5 years you can see it's quite stable. Obviously, when I say stable, I am not mentioning the pandemic because that is quite an event that doesn't happen that often, so it's quite the anomaly when you look at any chart for any stock. After this, we have the Vanguard REIT Index ETF. It's a great way to get dividend yield on REITs, and you obviously have a mixed portfolio of Canadian REITs in this one. Again, great recovery and a great opportunity for growth, almost 10% opportunity for growth, and you can see over the 5 years it's been increasing quite consistently. ZWB is a BMO Canadian Bank ETF. Again, 5% dividend yield, which is very good because it has a mixture of different banks. And this is something I've held for a while. I think I held it around the $15 mark, then again at the $16 mark before I sold it and bought the actual banks themselves. So great ETF. Then we have the energy companies. Energy companies, I'm quite skeptical about them. They offer great dividend yields, but obviously with the whole EV sector, I'm not sure if oil is like a hot market, but nonetheless, I think there's an opportunity to make some money. And so Canadian Natural Resources, 4.7%, probably one of the biggest energy companies in Canada. Then we have Suncor, 3.22%. Again, did a pretty good recovery, and there's a huge opportunity for growth. And let me go back to the Canadian Natural Resources chart. So if you look at the 5-year chart, again, opportunity for growth. Here's Suncor. And the nice thing about these companies is that they're so big that even if there was a whole shift towards the renewable sector, these companies have the capital and the assets and the investments to be moving towards that change in trend. I also want to recognize some other energy stocks. Keyera Corporation, I held this for about 5 or 6 months. Pretty happy with the dividend yield of 7.75% right now. And again, when the markets open and the pandemic comes to an end, I think these stocks are going to be soaring. After this, we have some of the consumer discretionary or staples. So Alimentation Couche-Tard is amazing. It's offering a very small yield, but it's sitting pretty low. There's almost a 10% opportunity for growth. So I wouldn't be surprised if in 5 years this is a $60 company. Next, we have Canadian Tire, 2.83% dividend yield. Canadian Tire is a pretty popular auto repair, hardware, sports, leisure, houseware store in Canada. And they have other subsidiaries, including Mark's Men's Warehouse as well. So a very solid company, which has been around in Canada for a while. And I feel like no matter where you go in Canada, you're going to come across a Canadian Tire, especially in the heavily populated cities. Then I'm mentioning Manulife. I do think it's a good idea to own at least one insurance company. And out of Sun Life and Great-West Life, I find Manulife to be more stable, and it does have a higher market cap. 4.3% is not a bad yield, so this is something I would jump in and probably buy soon enough. It's been on my watch list for too long, and I think it's time that I place an order for this stock. So I think we have about 7 more stocks remaining, and we're going to jump on to the US side of things. So Coca-Cola, 3.35%. It had a very nice drop just this month right here, dropped about 3.5%. That was a great opportunity to buy. Again, buy the dip. And if you look at its 1-year chart, pretty consistent, but again, has an opportunity for growth. 5-year chart, pretty stable. Huge market cap, pretty much this company can be moved. Then we have Pfizer. Pfizer has a very nice dividend yield of 4.66%. And Pfizer isn't really just a COVID play. In fact, the whole COVID vaccine, I know there's a huge hype about it, but I know they're making billions, but that's not even a big portion or a big chunk of their company. They make a lot of medications for other purposes, and the whole COVID-19 vaccine sector is just adding to their growth. And you can see over the last year at its ultimate high in December, it was at $41. It's dropped quite a bit, but I think it's so stable. Like, look at its 5-year history, even its MAC chart, extremely stable company. Then we have Apple. It's one of the few tech stocks that actually gives you a dividend yield, 0.66%. I know it's small, but it's Apple. And Apple presents you with huge opportunities for growth. So look at the 1-year chart. We're up about 73%, and over the last 5 years, we're up about 386%. So dividend yield plus growth. Then we have Walmart. Again, Walmart I'm recommending because of this event. So after its earnings reports, it actually went down. Again, this is the same time that the bond treasury yields were announced. And so it dipped quite a bit, and I think it's a good opportunity to buy. And then we have Home Depot, very similar to Canadian Tire. It's a US company. But again, you would see this in Canada as well. 2.54%. Over the last 5 years, amazing growth. Over the last year, it's made a nice recovery, pretty stable. And again, it had this drop, which is why it's on my watch list now. And next we have Lockheed Martin Corporation. This is by far probably the most unique stock that I've mentioned today, and because it's an aerospace company. And the reason why Lockheed Martin has such amazing consistent growth is because of its ties to the US government, and they obviously make aircrafts for them. They have a huge market cap of $94 billion, and they're offering a dividend yield of 3.07%. To me, that's a pretty attractive yield. And I don't think it will have any major stock price fluctuations over the next 10 years, making it a pretty good long-term hold to your portfolio. If you look at the last year, since November, we can see that it's dropped quite a bit, almost 10%. But I have no doubts that it's going to go up. Again, this is one of the big companies in the aerospace industry, which I think, just based on its sheer market cap, cannot be easily manipulated. Now, these are just some of the stocks that I believe in. However, there are many other stocks in the market with a similar performance. So you may be wondering, how do I pick these dividend stocks? Well, I pick them based on 5 things. First, at the time of purchase, the earning growth expectations should be above 5%. Second, the company should have a healthy cash flow generation. Third, the company should have a strong history of dividend payouts. In fact, an increasing dividend history is a huge plus. Fourth, I would avoid companies with a debt to equity ratio of more than 2. Fifth, I would check sector trends to ensure that companies are positioned to thrive and are at least capable of adapting to a change in these trends. Well, thank you all for watching this video. If you found this video to be helpful, make sure to hit the like button. Also hit subscribe and the bell notification button to be notified of my latest content on this channel. As always, feel free to share your insights and leave any recommendations in the comment box below. Thank you again, and I'll see you in the next one.